Let's talk about DataDog, or DDOG, as Pete likes to call it. Reported strong Q1 earnings, beating expectations. They beat on EPS, earnings per share, as well as revenue. And they gave optimistic guidance, Pete. So that's why the stock is moving pretty well on a day when some stocks, like we just said about Disney, aren't doing so well.
One of the negatives that I'd throw out there is they have incredible growth. We all know that. A lot of these companies have had great growth, but it's starting to slow to some degree.
Yep.
So the gross margins a little bit higher. The guide was in line. They gave you both sides, and I think the interpretation of this is, okay, it's been a powerhouse. It's been a really an amazing company that's done a lot of things right, but it is starting to slow. It's inevitable. Those things just seem to happen over time. You can't always just have that incredible growth forever. And it looks like to me the DataDog right now, that's the one negative, and probably if somebody's looking for a negative right now on the stock and why they'd be selling rather than buying, it would probably be that factor, the fact that growth has slowed to some degree.
Pete's exactly right, folks. It's why, even though they had these positive EPS, revenue, and good guidance, it wasn't as good as the street was looking for. So you always have to know what the street is looking for. So somebody could just tell you and, say, I think they're going to have this for earnings. And if they exceed that, great. But if the rest of the analysts are saying, well, we were looking way out here and these guys missed by a lot, that's why the stock's down 11%.
Yeah.
Because you can have great earnings, again, revenue and guidance, but if all three of those going forward don't exceed expectations, people are going to hit the exits. And right now, Pete, it's at, I think it's pretty close to its 52, well, not 52-week low, but the year's low. And here we are in the 5th month of the year, so that's a pretty big drop.